7% overnight. If you missed the news over the weekend, President Trump has decided to blockade the Strait of Hormuz. And it's kind of a desperate move. It is what it is. But essentially, Iran and the U.S. tried to come to terms. Those terms didn't happen. They wouldn't bend on a few things. The U.S. wouldn't bend on those. And what has been happening is Iran has been basically blocking certain ships of oil from coming through the strait. That's caused a big disruption in energy prices. We all are learning at the pump. And so Trump has now come in and said, okay, you won't open it? Fine. We're not going to let anybody in, and we're going to block it even worse. And the goal of this is twofold. One, they're trying to stop Iran from collecting tolls. They're getting millions letting these ships through. They're trying to cut off their funding. Secondly, Trump believes if he blocks everyone in and out, then the global community will have to then help him to get a deal made because no one's ships are getting in or out. And that's causing a shock to the oil markets. That's causing the indexes to gap down just a little bit. Not too bad. We have the S&P down about 0.5% since Thursday. NASDAQ around 0.4. Dow taking it a little worse, but still up pretty nicely from the highs. And when you look at the fact that we are in the middle of a war and the index is trading 3% off of all-time highs, that is actually a very strong sign of strength, okay? So what I want to do today is kind of break down the areas that are the strongest in the market. We're going to go through where the money is flowing, where the best opportunities are, and try to find some actual stocks that are worth buying in here or shorting. I'm also going to take you through the stages of the stock cycle that every growth stock follows so that you know exactly what stage a stock is in and whether it's time to buy or sell. I'm also going to drive you or walk you through the underlying fundamentals of the market. And these are the technical signals I look at to read whether conditions are healthy or whether they are poor. And then finally, I'm going to show you exactly what to look for that says this bull market is back on. The precise signal that we've seen signal the bottom of every single decline. That's in the 2020 COVID drop, the 2022 bear market, the trade war in 2025, the 2008 and 9 crisis, all of it, same signal every single time. It tells you it's time to get back into the market, okay? So let's go ahead and dive in here, and I'm going to try to, somehow I don't see your comments. Give me 1 second. I'm going to pull these up here. And window, okay, let's see. YouTube interview, nope, that's not it. Well, tell you what, let me just open up YouTube here. That way I'll be able to see you on the side, okay? All right. Here we go. Okay, so Frank, Michael, Ms. Taylor, Maui, Jim, Douglas, Curtis, good to see you all. Welcome, welcome, welcome. Now, if you're joining us for the first time, be sure to hit that link at tradewithross.com to sign up for our Black Ops service. It's just $5. We do these live sessions every single Monday morning. Right now, we're doing them on YouTube. Sometimes we pull it back and move them over to Zoom, so you'll get access to them. You get another Thursday session with my analyst. All the indicators I show you today, my weekly newsletter, tons of stuff. It is $5 for the year, no string. So if you're not a member, be sure to click that link and get signed up. I guarantee you it's the best $5 you will spend all year. So let's dive into the market. Ziggy, what's up, man? All right, here we go. Now, one thing I will die on this hill is that when you are looking at where to invest or which stocks are the best opportunity, you always want to follow the strength. Every bull market from the 1800s up to today in 2026 has had a theme to it. There is always leading areas, leading sectors driving that bull market. And in the 1800s, it was railroads. In the 1990s, it was .coms, then it was big tech, then it was work from home, then it's been AI, then it was energy and metals, and there's always an area leading. And why is that important? Well, those are the areas with the most stocks going up the most significantly. And so you say, oh, we've got a bull market. Everything, the indexes are going up. But, over the last, let's call it year, if you owned real estate stocks and consumer staples and what's some other shit, like these random areas, those have not progressed. Gold, silver, metals are up big. Energy is up big. In 23 and 24 and 25, semiconductors and tech were up big. Those are leading areas. And so it is crucially important at all times to know the theme of the market, to know where the money is flowing. Because it is not you and me that move stock prices. It's not our 100 or 1,000 or 10,000 shares moving. It's the 10 million shares bought by Goldman Sachs. It's Warren Buffett's, $40 billion position in Apple. It's these big mega firms. And so whatever they are buying, the macro picture they're investing into, those areas, those stocks, those sectors will rise more than the others. And I kind of think of it like fishing from a stocked pond. You can go out to the middle of the Atlantic Ocean and hope you catch a fish. You can go to a stocked pond full of largemouth bass where you can put a kernel of corn on a hook and catch something. That's what focusing on leading areas does. The whole group's going up. All these stocks are being bought. Don't fight the current. And so this is our industry strength indicator. And it's actually very simple. It takes the leading 40 areas, 40 sectors, subsectors of the market using ETFs, and just track their performance over various time frames. I've got it set up at 1, 2, 3, 6, 9, and 12 months. And you can come in and look at the best groups, the worst groups, the top 6 or 7 or 2 months or 3, however you want to do it. But the whole idea here is just see what is consistently outperforming. Is the market in favor of semiconductors or solar or gas or what is it? And obviously, this has changed a bit over the last 6 weeks with the situation in Iran, with oil going from 60 to 120. It's pushed the energy sector up. But the big picture theme and what we've been seeing for the last, call it 12 months, has not changed. And the big theme of this market has been metals and energy. And all of this really lines up with the bottleneck in AI. We know this is the biggest technological advancement of a generation. We know what it can do. I was playing with a bot this morning. It is insane, and it will make you angry. You've spent all these years of your life learning this stuff, and a clanker can get it done in 20 seconds. But the bottleneck in it all is the physical resources. These data centers, these football field size, massive warehouses full of $40,000 NVIDIA GPU clusters doing trillions and trillions and trillions of computations per minute require physical stuff. You can't build them without steel, without copper, without lithium. They can't run without the power to do it. And that's been the bottlenecks. They're using so much of the physical grid. The fact is today's modern grid was not even built. Today's grid, was not built for the amount of electrification we're doing, much less to suck at these data centers. And so they're having to find power somewhere else. Is it going to be natural gas? Are they going to make nuclear work? Is it going to be solar? A combination of them. All the energy groups have been rising because big hedge funds and mutual funds and pension funds see this and are buying those stocks. The metals being used, the aluminum, the copper, the steel, those areas are doing very well. And so the theme we see play out of the top 8 sectors, natural gas, energy, which is just oil and gas overall, natural gas, energy, the utilities, natural gas, energy, lithium, which is obviously the main component in batteries, lithium, steel, natural gas, energy, rare earth metals, more metals in here. They need the magnets and the names are slipping, but you know what I'm saying. Lithium, gold, mining and metals. So it's the physical things that's been the leading theme. And we have not seen this in decades. It's been the tech companies, it's been the fancy computer, Silicon Valley, but no one's thought about the guys pulling the ore out of the ground, the linemen generating the power. And now that's the bottleneck. Now that's what they need, and that's where the big opportunity is. Now, this indicator, by the way, we do give away for free, for life, to all of our Black Ops members. So I highly, highly encourage you to have this on your chart. If you have TradingView, you just upload, you just add it on here. TradingView, this charting platform is free. We'll authorize you for it. Then you'll just go in here and go to TA Industry Strength right there. Just add it on your chart and set it up how you want it. So if you're not a member, click the link. Go to tradewithross.com. It is $5 for a year. You get this for life. My newsletter every week for a year. Live sessions. If I don't give you $5 in value, call me. I will mail you your $5 back. Okay. But this is where the money is playing. So am I interested in buying software companies right now? No. Do I want to buy, Facebook? No, I want to buy the physical sectors. I want to buy energy. I want to buy metals. Shipping, we're seeing rise here with the geopolitical tensions, which may be short-lived, but we really want to focus on those leading areas. And so your life is going to be dramatically easier as a stock trader, as an investor, if instead of sifting through 6,000 stocks and reading every tip on every Reddit board, you instead just focus on the leading areas. And you say, okay, it's energy, it's natural gas, it's metals and mining. And so I want to focus on those leading stocks. And so how would I do that? Well, it's actually quite simple. And this is how you build your watch list of stocks. Now, we're going to go over exactly where to buy these, where to sell them in just a minute. But I want to show you how we're finding the stocks we pick from first, okay? So one of the big areas here, energy. Okay? So here's what I do. Google whatever the topic with the letters ETF after it. Now, ETFs are exchange-traded funds. These are the modern-day equivalent of mutual funds. They trade just like a stock, but it holds a basket of stocks. So XLE is the big energy ETF. And in any account, your IRA, whatever, you buy shares of XLE. And when you do, that XLE holds Exxon, it holds Shell, it holds BP, it holds, all the big energy companies. And so these look at that, 39,000 million. They have 39 trillion, no, that's not it, 1,000 million, $39 billion under management. And so they have very good professionals who are building this fund, who are deciding which stocks it owns, and they have to report those publicly. So all you got to do is click on holdings, and it will give you their top stocks by weight. And so their biggest holding, ExxonMobil. Next is Chevron, ConocoPhillips, SLB, Williams, EOG, et cetera, et cetera, et cetera. And you can even download this as an Excel spreadsheet. And so what you get is a professional fund's top holdings in the energy sector. They've already done the homework for you. And this is what that spreadsheet looks like. Oh, you didn't see that page. I'm sorry. It's only showing the app. Anyway, I think it is anyway. Is it showing the whole screen? Let's see. No, I don't think it is. Okay. Well, anyway, if you Google that, see if I can. Oh, that's not it. That's not it. I think it's this one. There it is. Okay. Sorry about that. I had it set to share the app, not the screen. Okay. But all I was showing you was if you go here and just hit energy ETF, find the big energy ETF, which in this case is XLE that holds all those stocks. Right here, the word holdings, right here in the middle. They're all required to report this stuff. And so there's the top 10 stocks they own. You can even download that exchange traded or the Excel spreadsheet of that. And this is what it looks like. And it'll give you, let me blow this up a little. It'll give you all the tickers of all their top holdings: XOM, EOG, VLO. So just copy those, build a watch list. Just call it, energy stocks. I've already done this. Hit add and fire them all in there. And now you have the top 15 energy stocks sourced by professional Wall Street money managers. Pretty straightforward. And so this is how we build our list. This is how we know where to focus. We go, all right, where's the leading groups? Well, it's mining and metals, it's energy, it's copper, steel, whatever they may be. Give me the top 10, 15 stocks in each of those groups. Now you have a stocked pond of 40 or 50 stocks to look from. You're not screwing around with anything else. And I almost guarantee you will see better returns just doing this. Would you mind hitting the settings button on your top stocks? Mine is showing semiconductors, lithium. Okay. Let me see. So this is what I have: 1, 2, and 3 month, showing the best 7 in the top right. I have another. I added 2 on here. So the next one shows the best 7, 6, 9, and 12 month in the bottom right. So I've got 2 of these displaying those. Now, if you see a little indicator, something here, or a little symbol saying to update, you may need to update the app. Will photonics hurt copper overall? Curtis, God, I love you, man. You're so smart. I just wrote this. It's funny. I'm doing a YouTube video on this. I just wrote this earlier this morning on photonic cables and how it will impact. So that I'm going over the big photonics companies, so Applied Opto, Air Test Systems, and specifically how that's going to affect copper. Now, the demand for copper, you're smart in thinking that. He's thinking, all right, is these photonics cables going to replace the copper? It's a very, very small percentage of the copper demand. The bulk of copper used in AI data centers is generating power, is power transfer. So great question. I think that the impact is going to be like less than 1% of global copper demand. How would the heat map work on Thinkorswim? Well, you have to build it separately. I don't have it for Thinkorswim. I'm sure you could, but if I were you, I'd just get a free account at TradingView, add that on there, and just use it for that. Each of the 5 surges in oil prices in the last 50 years crashed immediately after the war crisis was over. Are oil and LNG too risky to chase now? Yes and no. So you are 100% correct that once the big crises is solved or out of the way, correct, energy prices come back down. Now, that absolutely could happen if Iran suddenly, overnight, says, you know what, we've decided to abandon our nuclear ambitions. We probably shouldn't have a nuclear weapon. We should play nice. You've destroyed our entire military. We have nothing left to live for except our pride. But, why shouldn't we just give in here? I mean, I'm being sarcastic, right? But I just don't see that happening. And the blockade over the Strait of Hormuz, the disruption in global supply, I believe are going to feel the aftershocks of this supply crunch in energy for, at a minimum, 3 to 6 months out. So you are 1,000% right. Yes, they're extended now. Yes, a lot of these stocks are very, very rich valuations. And no, I wouldn't just chase ones that are already up 50, 80, 100%. Having said that, the entire energy sector, if it kind of resets and so like if we look at XLE, for example, it is now pulling back a bit. It's pulling back to kind of its 50-day moving average in here. It's about 10, 11% off the highs. And where I like to buy stocks or sectors is right in here as they emerge from consolidations. And this is absolutely crucial for timing your entries and exits. And if any of this is over your head coming in hot. Again, sign up for the blackout. Just go to tradewithross.com. I promise if you join me for an hour every Monday for a year, you'll be a whiz at this stuff in no time. But this is where you want to buy. You want to buy after you get these consolidation periods. You want to buy right here as it breaks through resistance, right there as the stock is emerging higher. And there's a very rational reason for this. Stocks, sectors, markets tend to be in one of two phases, and that is either price acceptance or price discovery. We have to remember that the stock market is an auction. It is buyers and sellers trying to agree on price. It's no different than the real estate market, than the automobile market, than the rare coin market. If demand exceeds supply, if there are more people trying to buy than sell, the price is going to go up, and vice versa. And so when supply and demand are roughly equal, when buyers think, yeah, this is a pretty fair price, and sellers are like, yeah, it's a pretty fair price, it's known as price acceptance, and it tends to kind of stay flat in here. But when demand exceeds supply, when there's more people trying to buy than sell, you go into price discovery mode, where price is trying to find a new value. And listen, when supply exceeds demand, when everyone's trying to get out and in, it's going to discover the other direction. But these consolidation periods here can be very, very powerful, because what's happening in here is those big funds we talked about, the Goldman Sachses, the hedge funds, the endowments, the Warren Buffetts of the world. When they're buying up a stock, a sector, an area of the market, they don't just go into E-Trade and go, give me 1 billion shares. There's not that much supply out, not that much is being traded. And so the advantage we have as everyday investors is the fact that we're not $50 billion funds. Maybe I've got some billionaires in a room here with me. I doubt it. For you guys, you still have a problem. But if your net worth has 2 commas or less in it, you can get in and out pretty quickly. And so when these funds are buying, they spend weeks and months building these positions. They're not in and out as quick as you and I. And when they do that, it creates this kind of shallowing consolidation pattern I've drawn out here on the chart. And there's going to be shocks from people selling or whatever goes on. This was the tariff situation. If your job is to build up 50 million shares, you're going to take advantage of that and buy it. There'll be little profit-taking periods they're going to take advantage of. There'll be downgrades to stocks. There'll be spoofing orders. All this, though, each and every time, they're taking advantage and buying. And what happens is you get this shallowing pattern. And when I say shallowing, all I mean is these dips tend to become smaller and smaller. The pullbacks go from 15% to 10% to 7% to 5% to 2%. They're shallowing. And what that's telling you is that the stock is becoming harder and harder to buy. They are sucking up the supply. They are absorbing those shares until they've bought all they can get their hands on in this price range. Until all the $43 and $44 and $45 shares of XLE are gone. Until which point, once they've bought up as much as they can, they've gobbled up all the shares people are willing to sell. At this point, they have to pay up for it. All right, what would you take? 46, 47, 48, 50. And that's how a stock, a sector, an index, Bitcoin, gold, any asset can go very, very quickly higher. Now, in this case, you had the added demand of people wanting in because of what's happening in Iran. But notice this move began back here in January. The Iran situation didn't trigger. We didn't invade Iran until February the 28th. So don't think this is all an Iran move. This was well underway in the energy sector 7 weeks leading up to Iran. Now, did people know we're going to invade Iran? Did the hedge funds with $50 million research budgets kind of model this out and say, we see the talks from Trump and Iran, and we're kind of laid out that we think this is what's going to happen? Probably. Yeah, that was probably part of it. But the reasoning doesn't matter. Our goal is to buy right here at 45, 46 when it breaks out and get that explosion higher. And this is the entire energy sector. This is XLE. Let's look at the individual stocks. Here's ExxonMobil. Look familiar? It's the same pattern because the whole energy sector moves together. Only it went from 120 to 180, went up 46% in 30 days. And you can look at all these and you'll see pretty similar patterns. That's ConocoPhillips, which came back to life. That's EOG. That's Schlumberger, Marathon, Phillips 66. And the charts are going to vary here and there. In fact, OK was on the way down before. But the big picture is that if you can buy precisely, if you follow a leading area like energy, you let it compress and consolidate, let the big funds suck up the supply, and you buy as it emerges here. What you are doing is stacking the odds in your favor in every possible direction. We have a bull market. Sure, we're down 5%, 6%, lottie freaking die. We're up 50, 60, 80% over the last couple of years. It's a bull market within 3% of highs. We have a leading group. Clear as day, it's been energy leading for months, for quarters. We have a top stock in the energy sector. Ask anyone to name 5 oil stocks. Exxon's going to be one of them. We're all familiar with Exxon. And we have it breaking out of this pattern where we have clear consolidation. We have compression. It's like a spring. These funds are buying it up. They're swallowing up the float. And it's like a spring compressing its energy until eventually it's going to release. And that release is where the money is made. And so you've just stacked this. You have a bull market where you're going to do better. You have a leading group that is outperforming. You have a top stock in the leading group, one of the best performers. And then you have this technical breakout pattern where you should see an explosive move. So it's like, is this guaranteed? No, but your odds are a hell of a lot better than randomly picking turd meme stocks from a Reddit board. And the beauty of this is you don't need to risk a lot of money. How do we know when we're wrong? At what point, where does Exxon need to fall to tell me, nope, I'm wrong, I need to get out? Right there. That's my risk. I buy here at 120. I'm wrong if it goes to 115. I'm risking a whopping 5% on this stock, and it went up 45% in 30 days. Even now, after the pullback, I'm up 27% on a 5% risk. And this is Exxon, okay? This is not a stock that typically quadruples in a year. You wait till you see what we made on the nuclear stocks, on the semiconductor stocks, when those were booming. The stocks that can double and triple, quadruple in this period, okay? So this is why I trade this way. All the odds are stacked in my favor. Every possible advantage I could get as an investor and a trader, I have with this. And I'm doing all this with very minimal risk. I almost never risk more than 10% on any one stock. Is this the only way to skin the cat? No. Buffett doesn't trade like this. He's had a pretty decent career over the last 7 decades. But he's seen his account go down 50, 60% at a time. He has periods where he massively outperforms. He has decades where he underperforms. I'm not going to underperform for a decade. Buffett has a very long time horizon that I do not. And he hasn't really outperformed in the last 20 years anyway. But there's scalpers, there's day traders, there's all kinds of ways to do this. I'm not saying I'm the only game in town. I'm saying my goal is to buy stocks I can hold for 2 to 10 weeks. Get a nice little burst of 30, 50, sometimes 100, 200%, and then move on to the next one. When I'm wrong, I'm going to lose 7 or 8 or 9%. When I'm right, I'm going to make 40 or 50 or 60 plus %. And over time, that edge is going to compound, and it can do so in a big way. When markets are ripping, I'm going to be printing cash. When markets are pulling back and there's no area with any strength, fine, I'm going to take some hits here and there. And sure, sometimes I'm going to get at the absolute tail end of one of these. I'm going to get a leading group, and like the semiconductors were leading in second half of 22 and 23 and 24, and then finally in 2025 they peaked out. Okay, you took a 10, 15% hit on the top after a 1,000% on Nvidia. You're going to be okay, right? But this is my general approach. It's top to bottom. Leading areas, leading stocks, clean breakout patterns or pullback buys, and getting in very tight, using a scalpel to my entry, risking 5 and 8 and 10% to make outsized returns on the upside. That, broad strokes, is what we do. Now, if you want to learn how to do this, again, there's a link at the bottom of the screen. Just click tradewithross.com. Give me $5. I promise I'm not getting rich off that. It doesn't even cover our cost, but it's a way to say, okay, this guy or girl is somewhat serious about it. I'll teach you how to do this stuff every week for a year. You'll get my newsletter. If I can't get you to speed, maybe it's not for you. All right, let me answer some questions here because I've just gone on a rant, and I apologize, but I get that way, so forgive me. Where are we at? Think about the copper and chips and cars and motor. Yeah, copper everywhere. And look, if you look at copper, it's, oops, I get this scale right. There we go. The trend over the last, 4 years is very, very clearly higher. It's up almost 100%. And the macro picture on copper is that the demand just vastly outweighs the supply. At least over the next 3-5+ years. We have a deficit by the millions of tons each year. It takes 5, 10, 15 years often to get a new copper mine up to speed. All the good copper has already been mined, so now we're out there chasing grades that are a tenth of the purity of the stuff we were pulling in the 80s and 90s. And we have, the electrification of everything. We have these massive AI data centers, all the big infrastructure built out. It's a big, clean macro play. So I'm long some, not a lot. I've got I'm so angry. I bought a third contract right in here, and then I was going on vacation for a week, and I chickened out and closed it, so I'd be up a little more on that. Now, again, this is not a huge position. I'm only up a couple of percent, which is, $5,000 or whatever at the moment. My goal is to, as this advances, add more and more and more as the profit progresses so that I'm not overly leveraged. So this is copper futures. Each one of these contracts represents 25,000 pounds of copper. So if you do the math, that's what? 150 grand basically in physical copper per contract. Now, my goal would be over the next, call it 12 to 24 months, to be long 5, 8, 10 contracts, which for me would be a very big position. For some of you guys, a $2 million copper position is peanuts. For me, that'd be, pretty substantial size. But I don't want to over leverage. Now, I could go in here and buy 5 more. But if this happens again, it's going to sting, right? So I'm kind of being a chicken about it. But there's lots of ways to play copper. There's COPP, which is the Copper Miners ETF. There are individual miners. Some of you are mentioning some of those. Yes, I still love all those same copper miners. I like, what were the ones you, yeah, FCD, no, what are the ones you guys mentioned in here? Sorry, I'm going back through. Hold on. Taseko, yes. So Taseko Mines is one, TGB. It looks great. Now, if you want a little bit of proof of what I'm talking about, I know this is kind of Monday morning quarterbacking, but you can see some of these exact same buy points in a stock like this. So, again, is it perfect to the exact penny? No, but this is the stock market. It's imperfect, right? But this is what you're typically going to see. You're going to see a move higher. This was about a 70, 80% move in a couple of months. You will then see it come in and shallow and compress and kind of tighten. It then breaks out, makes another big run. It then goes into another consolidation where, again, it shallows, little kick down, but responded back, breaks out again. big run. It starts to consolidate, then we're going to war. Does that change everything? It was a curveball. It threw a wrench into our perfectly well-oiled machine. Now we're spending more in the military. Just going to mess everything up. Is the economy going to take a hit? We don't know. Let's just panic and sell it. And so it came down, but it's responding in kind. But anyway, that's that. Like, these are the entry points I look for, right? For these explosive moves. But yeah, Taseko is a big one. There's several other big copper miners. Still very, very bullish on that. Mark 1, Mod 0, cup and handle pattern. Which one are you talking about, Jack? Okay, sorry, I'm going back through. I have semiconductors on top first from monthly settings. That shouldn't be the case. I don't know why. If you need to, just call our team, 407-606-5674. Ask to talk to one of our tech guys, because that should not be the case if you're seeing that. Syntec Optics, okay. I like XLE, EXE. Douglas says it will take several months to get some oil fields back online. Yeah, I mean, even if you look over there in the Arab nations, right? I mean, some of these is shut down because they don't have anywhere to put the stuff. I mean, here's how it works. You're drilling the stuff out of the ground, okay? And then it comes out of the ground into big tanks. They have a capacity. Those tanks then do one of two things. Either it goes into a pipeline, which feeds it around, directly to some kind of oil refiner that can take it and turn to gas and barely get it out. Or it goes into a ship, which is in the ocean, which then floats it around the other side of the world again to a port and right into a refinery. Okay. The problem is 20% of that oil globally goes in ships through the Strait of Hormuz. And that's what they've closed. So when you look at the Strait of Hormuz, let me find you a good image here. Okay, here we go. And most of you know this, I apologize, but this right here, this tiny little gap right there, is the Strait of Hormuz. And Iran's got a bunch of inbred war fighters and machine guns sitting right here, throwing explosive grenades in the water and all this crap, and saying we're going to fire our RPGs at anyone to go. And you're a regular guy. You work on an oil tanker. You're just trying to get home and see your kids. You're not trying to get your head blown off by some Iranian with a homemade bomb. And so you're not going to risk it. But what goes through here? Well, all the oil from Syria, Iraq, Kuwait, Qatar, Saudi Arabia, all of it goes here and through that little tiny pass. And Iran has no other card to play. Militarily, they've been decimated. I'm not defending what the U.S. did. I'm not saying it was right, but the fact is they've been absolutely decimated. They cannot hold it. No country can fight off $1 trillion annual budget military, right? And so the only thing they can do that will negatively affect the U.S. and Israel is fight economically. And this is all they've got. They're not a big player globally with anything else, but all that oil goes through that Hormuz Strait. And so they said, fine, you can't come through. And when you take 20% of the global oil supply and suddenly it can't get out, well, then you have the situation we have now, right? Because sure, Kuwait and Iraq, I mean, they've got pipelines going out, but they can't pump it all. There's just not enough capacity. A lot of it has to go on ships and out. So that's a situation going on. And it's going to take a while for us to normalize because all the ships currently out, that are constantly out there floating full of oil, they've kind of, a lot, if that little supply runs dry, it takes time to get new stuff out. So it's not something that's going to resolve itself in an hour. It's not something a tweet will instantly fix. We've invested in the bond option. Okay, we're unpopular and no one to buy our bonds. Now tankers are heading to Texas. How long will it take investors to buy up our bonds, get out of the option? I'm not quite sure. If you're talking about the bet that interest rates go higher, I still stand by that. I mean, regardless of the oil situation, the government debt's the government debt. We have $39 trillion of it. We're adding $2 to $3 trillion every year. Our federal debt has doubled in the last, 8 years, 10 years, something crazy. And, countries are seeing what we're doing. They're going, I don't want to hold all these dollars. I don't really trust that dollar is going to stay strong. I don't trust the debt they, and so when that demand decreases, it's just a fact. There's less demand for U.S. debt. People don't want trillions and trillions and trillions of dollars of bonds every year. Central banks are buying gold. They're buying other currencies. And when you have an auction, demand and supply plays out. If there's less demand for those bonds, they're not going to pay the $1,000 par value. They'll pay $950 or $900 or $850. And when you pay less for a bond, it pays a higher interest rate. It's a higher yield. That's what drives interest rates higher. And I mean, look at the 20-year yield. Now, what do you see? If we scroll back a couple years, let's just go to like a weekly chart. It's the exact same. Do you see that breakout pattern I was showing you guys earlier? Forget what the instrument is. It doesn't matter. Big move up. There's a demand. Shallowing, tightening, consolidation, tightening up here. What's it look like it's about to do? About to break out higher. The problem is this is the 20-year bond yield. Don't shoot the messenger. I'm just telling you, rates are going to go up, not down. I don't like it any more than you do. I'd love to look. I got a 6.35% mortgage. I'd love to be in a 3.5 or 4, like some of you guys are locked into. I'd kill to get them down, but they're not going down. They're going up, and they're going to be higher. Inflation's going to be more than we expect. They're not going to cut interest rates. If this Fed doesn't play, new chairman doesn't play ball with Trump, they might raise rates. And even if they don't, supply and demand is going to play. Nobody wants these bonds. Nobody pays them. They're going to go down in value. That pushes the rates higher. This is the actual bond prices. I'm sorry. No, TLT. Sorry. That's the actual bond prices. And that trend is very clear. It's a breakdown pattern, right? So do with this what you will. But if you're sitting around going, I'm going to bet a fortune that rates are going to go down next year because Jerome Powell said so, that's not a bet I would take personally. Thoughts on movie theaters with starting April off with records at its best. I mean, talking like AMC. AMC, I mean, I was at it this week. I was at one yesterday. We had his 7th birthday party at AMC, rented out a little theater so his friends could watch the new Mario movie. And by the way, if you got grandkids or something, great. It's like $300 to rent a theater out. As many people in there as you want. Pretty cool. But does AMC move on ticket sales? No, it's a meme stock, right? It moves on pump and dumps. They're raising capital at crazy valuations. They're issuing cryptocurrencies like it's, I wouldn't bet on movie theaters because we had a good month with a couple of movies. No, absolutely not. Very new at this, but found a small LNG in Houston called Next Decade. Entered 3 days ago, up 5%. Well, Christy, if it's working, I'm happy for you. Good job. Let's take a look. Okay. So this is a small little stock. I can already tell by the action, $2 billion, okay, which makes it just barely a mid-cap stock. But yeah, this actually looks pretty good. Now, that same breakout pattern I showed you, right, where stock goes up and then compresses and tightens and then breaks higher, we'll see the exact same thing off the lows because it's the same principle. You're looking for the supply and demand imbalance. And you'll often see this kind of like you do. And it's not perfect, but you kind of see some same idea where as long as there's more supply than demand, more selling is going to keep cutting off. And then eventually it kind of compresses and tightens up and shallows in here and then breaks out to go higher, right? So, and some of the biggest wins we've had were off this. Like this is SMR. Now it's a turd today. It wasn't last year. We made a fortune off this thing because this was, let me turn the moving averages off. This was the Terra 4 in early 2025, and these big leading stocks from 30 to 5 or 10. But then we got this breakout pattern that formed here. Whoops. Where SMR, which by the way had been a big leading stock. I mean, over here last year, this was a massive move. That was like 350% in 90 days. It just came crashing down because Trump declared economic trade war in the entire world. And so it took a big hit. But then we got this shallowing in here. And look at the big tighten. Look how it tightened up. and compressed and shallow. We bought this thing right there at like $18 a share, and it went to 50 something in a couple of months, 170% move in 71 days. And again, you can see this stuff, right? You just watch these to compress. That's a 44% dip. Okay. This next one, 22%. It's shallowing. This next one, 11%. The next one, 10%. So it's compressing. The dips are getting shallower. The stock is becoming harder and harder to buy. That's what you want to look for. And maybe this will be easier if I put it in log scale. You can see it a little clearer. But you want this tightening, 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 tightening. If you get it widening, it's usually getting uglier. That's not what you want to get into. You want to buy in as price action is compressing. Now, would I buy SMR today? Not with your money. Absolutely not. It's getting murdered. I have no interest. And you go, well, Ross, you bought it at 18. You won't buy it at 8? I'm not marrying these stocks. I have zero conviction in the long-term success of this. A couple of big macro pictures I'll bet on. Copper, I'll bet big on. Interest rates going higher and debt getting worse, I'll bet on that. Am I going to bet on whether NuScale Power perfects a small modular reactor and gets multi-billion-dollar contracts with AI hyperscalers before their competitors and legislation stays pro-friendly and there's no, I have no idea. I'm not that smart. I'm not inside enough. Okay? I think nuclear is going to do well 5-10 years. Are they going to be the winner? I don't know. But I do know when nuclear is a leading group, when the market is rallying off the lows, when this is coming out of a breakout pattern, I know I can risk 8 or 10% and have a real chance at doubling my money in a couple of months. I'm going to trade it. Once the price action widens and it starts to break down and make lower lows, I have no interest in it. And I will continue to have no interest in it. I don't care if it goes to $1. I'm only buying when I have what I believe is an edge. And this is what's known as swing trading. If you're trading on daily charts, you're generally trying to predict the move over the next 2 to 8 weeks. If you're trading on weekly charts, you're trying to predict the next 2 to 8 months. If you're trading on hourly charts, you're trying to predict the next 2 to 8 days. It's the same process, just different time frames. I tend to see the growth pattern only after it's done its rise. How do I find the stocks in the consolidation phase? That's the hard part, Rick, is seeing this and not being scared to buy it, even though the stock's at highs. Now, following this is going to be, following the leading group is going to be your best way to do that. And so, let's look at some of these stocks, for example. Let's look at the big energy names. We'll see if we have anything setting up here. Exxon, I think you do a pullback buy to the 50. It's right back to a previous breakout area, but wouldn't be my favorite. Let me find some stuff that's actually compressing. Okay, Schlumberger. Now, one thing that may help you that I do is I'll just drag the chart way down. Because when you see it up here at the top, just psychologically, I don't want to buy the high. But if you do this, I know it's stupid, but it does help. But is it perfect? No. But it's getting there. One more little tightening. So we had this big move from 35 to 55. It's coming. It's shallowed. It's tightening. I want to see a couple more days absorbing that supply. And then I'm going to buy this on a breakout above 54. And you go, well, Ross, you had a little move. Yes, it failed there. It went a little too far, too fast. It was a gap up on news, immediately came down 3-4%. It just moved a little too far, too fast. Don't expect these to stop right at the penny. It's not going to happen. It's the market. It's imperfect. It's buyers and sellers and fear and greed and news and Trump tweets and, Iranians acting tough. It's not going to be perfect. But we're looking for this pattern in here. So Schlumberger, a midstream company in the energy space, could get a huge deal in Venezuela. I think, this could be a very strong one. Marathon, pulling back to the 50, PSX, a lot of these. The Williams companies, okay, trying to find a really clean one for you. Baker Hughes looks damn good. Forgive my French. Yeah, I like Baker Hughes a lot here. See the big move, you get your dip, you're shallowing. Look at that 3-4 day just nice and tight right there. Yeah, I'd buy this on a breakout above 65 bucks. And if it doesn't go any lower than this, I'd put a stop down here at 62 and a half. If you really want to give it some room, put your stop risk 9%. So here's how you do this, okay? You do I want to see it break the high here. This high is what? 64.92, all right? And you can place these trades in advance. So you can use what's newest called as a buy stop. If you don't know, there's three types of orders. A market order is just buy or sell at the market, at the current price. That's just buy it now, sell it now. A stop order is if, then order, okay? A stop says if it hits this price, then buy. If it doesn't, don't. And then a limit order is an or better order. It says, okay, it's at 62. I want to buy it at 55 or better. So if it falls down, get me in the stock. But a stop order says only buy it if and when it crosses this price. So the high here, 64.92. I'll put a stop in and give it a couple cents, 64.95 to buy 100 shares of stock. If it hits, if I buy, I will then put a stop loss down here beneath this low because it should not fall below here, right? We saw massive buying come in. That was the swing low, so we'll call it $59.50. So we'll add a stop loss at $59.50. I will then set the time in force to good till canceled. You have two options. A day order is good for today. If it does not get filled, it is gone tomorrow. It disappears. Good till cancel order, it is like it sounds good until you cancel it. Don't worry about the routing. And so I'd be risking 545 bucks. So yeah, go ahead and place the trade, send the order. Now, orders are in. Do I own any Baker Hughes stock right now? No. Will I own it if it falls off a cliff and goes to 40 bucks tonight? No. It only buys if and when it breaks out and hits my stop, only if it goes up there. And so the nice thing about it is you're doing your research, you lose some of these. They fall through the cracks, and yeah, you can jot them down on a pad, but if you like, I really like this. It's a leading stock in a leading category with a clean pattern in a market recovering. Yeah, if it breaks, I'll take it. And so the trade is set up. If and when it fills, my phone will ding, this will ding. It's not like I'm going to forget it, and then I've got this big position I never saw. I'm in front of this all day. Okay. Let me see what other questions we got here. Okay. A lot of folks freaking out on this. I don't know why semiconductors is showing there. Is there something that looks, whoops, didn't mean to do that. Is there something on there that looks like this? Little arrows. It'd be right here next to that indicator. If there is, that means you need to update it. So do that, update it. If not, I don't know. Just call our number to figure that out because it's not, that's not what I'm seeing. I mean, I can add these, I can remove it. Let's see. Maybe it's a problem with mine. I'll add it back on. Oh, maybe I'm the one that's got an issue. Let me close this. It is possible. It's on me. Watch me look like an idiot here right in front of you guys. Let's see. Okay, it was me. I'm sorry, guys. Yeah, so that was mine. I guess my chart was frozen or back there for something. I apologize. So yes, yours are right. Everything's fine. I'm the moron. Okay, so a little bit different here. So semiconductors has come in pretty strong over the last couple of months here. Why? Well, let's see. Semiconductors is breaking out to new highs. And this appears to be a very strong area. I'm guessing we have Nvidia cooking back. No, Nvidia's not going anywhere. What is it? Intel? Yeah, Intel making the big move. That's going to be a big driver. AMD coming in. Is Marvell and these other guys? Oh yeah, Marvell's a big mover. Okay, so yeah, semiconductors on the move. Now I'll give you one little hint here, and this is kind of tough to teach, but one of the things, my preferred setup is that I get a group that's consistently leading. So it's leading, 2 months, 3 months, 6 months, and then it's not leading on the 1 month list. And the reason for that is, as you know, I want to buy when it's consolidating. And so oftentimes what you'll see, just like we had in here, is a group that has been leading and is up, 30% over the last 60 days, 20% of whatever. And in that final month, it's kind of doing this. Okay. And that is okay because that shows you it's finally taking a breath, consolidating. I still want to buy the breakout on that. So what we try to do is maintain kind of a list or a pulse of the top 3, 4, 5 areas and those rising up the ranks. Now, sometimes it's going to be so easy, it's going to be crystal clear. Back when I showed you that nuclear trade, it was like nuclear. I mean, the top of every single list. Or it was semis in 23 and 24. Like very, very, very obvious. Excuse me. But be cognizant of both the leaders in the 1, 2, 3, 6, 9 periods, but also those that are rising up the ranks. And so semiconductors has not been leading for a while, and now it is quickly coming up the ranks. It's leading in 1 month. It's popped up on the 2-month chart, the 3-month, the 6. So it's rising up the rank. Even the 12-month is starting to show up down here at the bottom. So that's probably an area you want to focus on. Been teaching you guys off dead list the whole time, but the lessons are the same. It's the same idea, right? Is 5% stop loss too little? Do you need more space for it to move like 10%? So are you talking about the Baker Hughes trade? God, I keep absolutely grabbing this thing. It depends on the stock. So what I would tell you to do is look here at the average daily range. And if you don't have this indicator on your chart, it's a free one. Just go to, what is it? ADR. There it is. ADR percentage / ATR LOD. I don't know. Some guy named Armor Schluckmaster or whatever made this thing. But the ADR is the average daily range. That tells you on average how much this stock typically moved from low to high. Now, if that average daily range is 7 or 8%, you're trying to risk 5, yeah, it's going to be a little tight. If it's 2 or 3, maybe you get away with it. I like to have 2 to 3 times the ADR if possible. At least one average daily range. Okay, because if you get the breakout right, it shouldn't go below the low. It shouldn't make a big swing down. You can I'd rather you trade these tighter than loose. I'd rather you take a bunch of 5% losses and a couple of 15 or 20s. But now, if you have a stock that's showing an 8% daily range, 5's going to be a little tight. If it's 1, 2, 3, you might be able to get away with it. It depends how tight the pattern is. What do I think of RENN? RENN? I must be looking at the wrong thing. I don't. I don't. I'm not seeing a stock like that. USO dropping, SPY rising. Guess that's the Hormuz answer. I mean, I don't know if I'd call this USO dropping. It's up 5% on the day, but okay. SMH and the semiconductors. Oh yeah, that's the other one. Yeah, this is the other ETF, SMH or SOXX. They're both semiconductor ETFs. They're charging me the same. Please review your current portfolio on screen. I don't have a lot on right now. I've got a couple of. I've got the copper position. I've got, as far as swing trades go, anyway. I've got some positions in those in Fannie Mae and Freddie Mac. Some of those for kind of longer term trades in here. That one's obviously not up a ton. You talking about my retirement account? Franimal the animal added 4 grand just by using information. Good for you, girl. Get it. What I want to hear. Please take a look at UNCY. Proud of you. Good job. UNCY. Okay, we have a micro cap. Micro, not even small cap. Biotechnology company. So already a risky little sucker. Having said that, I see what you see. I believe that's what you're talking about. Big move followed by some consolidation in here. Yeah, I'm not opposed. I mean, it's a mover, so strap in. But yeah, I'm with you. I mean, my preference is for more institutional grade leadership stocks, right? So the whole idea behind that breakout patterns is the big institutions are the ones making it with their buying and selling. And so I kind of want to focus on mid, large, mega cap stocks they can get into. They wouldn't be getting into a micro cap. It's just too small. They can't get enough shares. But the same supply and demand dynamics exist. It absolutely could be consolidation by individual investors. Yes. UNCY. We did that one. Check out NXE. Is this next gen? Yeah, looks. I don't know, man. It looks really strong. What I don't love is that it's kind of it kind of looks like it wants to break down. And I know that's not what you want to hear here, but I want you to look at the difference in these two things here. Okay, these two patterns. I'm gonna take these ribbons off. Now notice over here, strong move up, tightening, getting looser, but then up, tightens, 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 right up here against the highs, right? Resistance at 10, at 10, at 10, at 10, right? Then it breaks through and goes higher. The next one, what do you see? Kind of the opposite, right? Lower high, lower high. It's forming a support at 10, at 10, at 10, at 10. And I kind of think of support and resistance like a brick wall. You're sitting there with a sledgehammer. If you hit it once, your hammer is going to bounce off. If you hit it twice, you're going to see some brick dust, but it's not going to go down. If you hit the damn thing over and over and over again, eventually it's going to fall. It's the same thing with support and resistance. You bang against $10 a share, and you gobble a bunch of their shares and sells off. Bang against 10, you absorb a bunch more and more and more. And if you keep hitting it, you're going to get through. And the same thing's true on the downside. If you keep hammering against that price, you're eventually going to get it. So I know this is not what you want to hear. To me, it looks like this wants to go lower. And I'd be considering a short if it breaks through 11 with a target of about 8.5 or $9 a share. Now, they just posted that link back in the chart. Again, if you are new, if you're joining for the first time, I go ahead and sign up at tradewithross.com. It is just $5. The reason I say that, for some unknown reason to me, about 6 months ago, I was doing these live ones on YouTube, and we got a strike. And YouTube issues these strikes. If you get one, you can't post for a week. If you get two, they shut you down for like a month. And if you get three, you're off the platform forever, which I'm not going to let happen. I got one during these live sessions. I don't know why. I mean, I don't think I've fed anyone any hopes and dreams and fairy dust. I'm trying to be very real about the risk and reward here. But for that reason, we had to move them over to Zoom. So if you are not a Black Ops member, and that happens again, you won't be able to get access to these. The Thursday ones are only for members. That's over Zoom with our other analyst. You're also going to get this industry strength indicator. I put up my weekly newsletter. You'll get access to our team and some bonus reports. A ton of stuff there. Just go to tradewithross.com. If you're watching this on a TV, there's a QR code down the corners. Pull out your phone, scan that bad boy. It'll pop it up, and you can get signed up there. Well, does this make sense on NXC? I hope it does. Can you look at uranium? Yeah, I still like uranium. I mean, it's been more volatile. Pretty big swings. I just don't think it's ready, personally. Do I believe in it long-term, nuclear uranium? Absolutely, yes. I have long-term retirement dollars in this fund, this very one. I own it. But, what I want to see to trigger another move is kind of something like that. It's like You just made a 27% drop. If the whole sector is down 27%, it does not have broad-based institutional support. If the big hedge funds and endowments and pensions, if they're actively buying these nuclear stocks hand over fist, it's not going to fall 27%. So I need to see that tighten and compress before I personally want to take a short-term stab at it. NOK, is that Nokia? Wow, where'd this come from? Nokia on the move. Yeah, looks great. Nice momentum there in Nokia. KLAR. What do you mean it started moving? Hadn't gone anywhere yet. That's up a little bit today, what, 3-4%. Klarna, I did a video on Klarna, kind of a long term. Again, that's not like a short term swing trade. I don't want to act like I'm talking out of both sides of my mouth, but there's just different time frames. I can believe someone's going to be a good investment over 2, 3, 5, 10 years. Invest in it now, not worry about the price. If I'm trying to predict what's going to happen the next couple of weeks, I really need to see technical support for that. Okay, that's the only way I know to predict what's going to happen in the near term is by the technicals. I can look at ACRS. Beautiful. Yes. Alcaris Therapeutics. 500 million. So we've crossed the small cap threshold. Dermatologist led biotech. Novel drugs to needs and medical. Blah, 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 blah. What is it? Aesthetic dermatology. Beautiful, stronger market. K-shaped economy. All that. Yeah. I like this. Oh, we had this one for our fire trader pattern over in here. Nice little move there. Yeah, this looks great. I mean, you see this over and over in this stock. These just big shallowing consolidations where it breaks out, makes a nice strong move. This must have been some kind of news event or a drug trial, which can happen with these biotechs. But then, yeah, I mean, it's not perfect. Because, I mean, look, this thing went from $1 to 5. Okay, it's a mover. But just kind of draw you a line there. Are you seeing the overall structure, which is a big move followed by tightening, consolidation? Yeah, I mean, this looks great. Very, very good. Good pick. Write this one down. Let me dig into this. Who do I have to thank for this one? Frank, the industry, the TA2 script. Updated January 6th. I think that's the most recent one. Same one I got. Okay, let's look at a couple others before we get into here. Yeah, you guys really liking biotechs. Yeah, I mean, it's very strong. Little company, but great price action. BDTX, wouldn't be my pick. But you may know something I don't. Celsius looks great. Yep. This looks really strong. Wasn't a perfect breakout pattern, but if you just got that like 6 months of consolidation in there, just that coiled energy. It came off the lows. It's tightened, it's tightened, it's tightened. Now it's getting legs. Yeah, it looks very good. It's in the right group. What Netflix comment, Frank? You the one always roasting me on my my Netflix references, my YouTube videos. Apparently, I reference Netflix a lot. I don't mean to. Thoughts put NXC. I mean, I would. Yeah, I'd buy a put on NXC or short it. I mean, especially if it pumps up here to like 12, right here to the 50-day moving average, which I guess it just did a couple days ago. It's exactly where I'd want to enter a short and just say, all right, well, short it at 12, shouldn't go above 13, risk $1, because you're probably going to get $34 down move. That's my expectation. Anything can change. And, the energies are a little bit tougher because you got two factors going on. When you have most companies, there's not a lot of surprises. Their earnings may be a little better, but like analysts have done their homework, okay? With oil stocks, okay, it's a great company. They're a great refiner or driller or whatever it may be. They're really good at what they do. And then we drop bombs in Iran, or the Strait of Hormuz closed, or something like there's two factors going on there. It doesn't matter how good the company is, you get these unexpected shocks. So you are more prone to that macro risk in the energy space. Now, it can also pay you. Anyone who was long these energy stocks in that past breakout, this was this XLE trade we looked at in the beginning, right? And as I showed you here, energy, and we saw that from my outdated market health and industry strength indicator earlier, these that were backdated for some reason, not up to speed, but it was energy that was leading. This was the breakout, and you were doing pretty well. You were up, 15, 18%. Then Trump start dropping bombs, and suddenly you're up 30, 40%. So it can work both ways. Just know there is more risk, or I guess a higher chance of an unexpected move. LPG. I really got to go here. Dorian Marine Shipping. Yeah, I like this one. It's a bit of a mover. Shipping's kind of tough. It is showing some strength in here. I think it's worth the risk. I think it looks really good. It's definitely carved at a low. It's tightened off the bottom. It's absorbed all that supply from this massive, year and a half downtrend. So yeah, I think it's ready to resume its ride. I like Dorian. I like LPG. Copper breaking out right now. Let's see. There we go. Get moving, little copper. You son of a. I'm just kidding. It's been a frustrating trade. But we're still good. All right, good. We're getting a little bit of legs here. It had a really nice day Thursday or Friday. See that big move? A lot of you guys prefer candles. That make it easier to see. Nice big, like 2% up day, and then we kind of gap down overnight, but now it's coming back. So that's good. And the tough thing is, look, I'll be honest. I bought this over in here from a macro picture, and I saw this forming. I can send you the message to my analyst. I said, John, you see what I'm seeing? He said, yeah, it looks like copper's about to fall off a cliff. And I knew it. And I should have just canceled it out here. Like, no, I'm holding this for the long term. So I held through all this, and I do believe we'll be $7, $8, $10 per pound in copper in the next couple of years. And hopefully I'll be in this to profit from that. But this is just a big macro play. All right, guys, I'm going to go ahead and end it here. We are way over our hour time, but if you're join us next week, we do this every time. Should have warned you. I never take vacations. I never take time off. Ask Mike. I just don't. Next week, I am. I am going to Italy. Never even been to Europe. I'm going for 1 week. I will be out for a couple of days. I am going to miss the Monday live session. But we still have this Thursday's live. We still have next Thursday's live, and you still have every other Monday from now until April of 2027. So if you are not already, click the link in the description, scan the QR code, or go to tradewithross.com to get signed up. It is $5 for the whole year. If I can't give you $5 in value, like I said, I'll mail you a check to refund you. All right. Guys, thank you all for joining here today. Remember, the markets are risky. We know that. We've learned that over and over again the last couple of years. You always want to focus on the risk first, which is why I like this breakout pattern. I like to keep my risk tight at 5 and 8 and 10% to have a real chance of getting these explosive moves higher. And if you follow this process, I've seen it hundreds of times, you can outperform and you can improve your results. I hope you'll join us and become a very successful trader, investor in your own right. All right. Thank you all again. Any questions, comments, if you're watching this recording, put them down there in the comments. I generally see these. They pop up on my phone, and I'll do my best to answer each and every one. Thanks, guys.